Welcome to another episode of the Fintech Garden podcast. Today, my guest is Jonny Fry. Jonny is a head of digital asset strategy for ClearBank Ltd, established in 2015, becoming the first bank in over 250 years to be regulated as a clear bank in United Kingdom. Jonny is CEO of Team Blockchain Limited, a research and publishing firm that since March 2018 has produced Digital Bytes, a weekly analysis focused on the commercial opportunities of using blockchain technology and digital assets. He is a non-executive director of Turn, a blockchain-powered reporting platform for the asset management industry, and also serves as an advisor to a number of other firms. Jonny is chairman at Gemini Capital United Kingdom, which owns a Dublin-based fund administration platform, where he is regulated by the Central Bank of Ireland. Over 20 years, Jonny was CEO of Primer Asset Management Public Limited Company, a London Stock Exchange-listed asset management company that he co-founded. In our conversation, Jonny shares how digital currency could transform payments, highlighting the difference between e-money and true digital money, and why most of our digital payments are just electronic records. The growing impact of tokenization, from fractional ownership to faster, more transparent transactions. Why trust is at the heart of every currency and how blockchain technology might help rebuild it. We explore real-world examples, historical insights, and how this shift could change how we all interact with money. Let's dive in. So, hello everyone. My name is Igor Tomych, and today we are issuing another episode of Fintech Garden. And I'm really pleased to introduce to Jonny Fry, who is going to talk with us about the digital currencies and the future of the payments. So, welcome, Jonny, and let's open this topic. So today, I would like to discuss with you digital currencies, and it's a pretty hot one. And usually we start in with defining the terms, because by that it would be much clearer how we compare those things and how to deal with them. And maybe the first question, since everything right now, digital products, like you basically have your banking applications in your pockets, you might be using the web, everything is digital. And what is for you the definition of the digital currencies?
Well, I think that's actually a great place to start. And the reason that I was delighted to accept your invitation to come on today is that at the heart of every business is the ability to make payments and receive payments. So payments is at the core of every business. But the trouble is that when we talk about digital payments, we talk about digital money, people think just because you've got, one of these things, you've got digital money. But unfortunately, from a regulatory point of view, you may have an E for Echo, e-money license. You don't have a D for Delta, because we don't have digital money in this country at the moment. And there's a very, very big difference between e-money and D-money. E-money is typically money that's been created by a commercial bank. So Igor, if you put £100 with Lloyds, NatWest, Barclays, HSBC, whose £100 is it?
Yeah, that's a really good question. And that's money which are issued by the central bank. So in the first place, they actually, it's monetary based from the central bank. I will go a little bit boring about the financial terms. There is M0 term, which is defining all the monetary base. Monetary, and the central bank is usually like overviewing those parameters. And I've checked before the podcast, like what is the percentage of the real cash and coins in those M0. And usually, like if we talk about current situation with other countries and UK, it's around 10-15%. So 85% exist in digital form. And is it good enough to be called digital currency or not?
Well, no, because it's electronic money. So what it is, in most G7 economies, we have fractional banking. So as you've said, 10% of the money is real money. The other 90% is basically you put £100 with a bank. It's no longer your money. You're a creditor. They owe you now money. And what they do is then go and lend out your £100, maybe, 5, 6, 7 times for mortgages and overdrafts and loans. And if those mortgages and overdrafts and loans, if they all work, then who makes the profit? The bank does. If they don't work, then who loses? You do. And that's what we saw with Shearson Lehman when it went bust. That's what we saw earlier last year in Switzerland. Flowbank collapsed. We saw First Republic Bank in Philadelphia in America go broke. So what people are beginning to look at is say, well, is there a way that instead of having my money e-money backed by the balance sheet of a bank, can I put my cash into something that is backed either by central bank money or something very safe like a money market fund, or it may be backed by real estate, or it could be backed by gold. And then what you do, you can effectively, you're going to go back in time and you're going to go back to swapping a bucket of eels for a bushel of wheat, and you just swap. Now, at the moment, what happens, you have a bucket of eels and you go to the fishmonger and he gives you some cash, and you take that cash and you go to the greengrocer and then you give your cash and he gives you some wheat. Sorry, keeping it very, very sort of basic and simple here. But my point is that what we now have money exchange with the fishmonger, and money exchange from the greengrocer, and we've got sort of someone's got to pay the rent for those different storeholders and everything, as opposed to doing a peer-to-peer, an immediate swap, delivery versus payment. And this is what the city, whether you're in London, whether you're in Paris, New York, Singapore, they're trying to go for delivery versus payment. When I give you my shares, I want to be paid. Now, when I started the markets, you had 10 days, up to 10 days to make that transaction happen. Now it's gone to 2 to 3, but they want to get to delivery versus payment. And it's very difficult to do that with e-money, because most e-money, when at wholesale level, it's 2 or 3 working days, business days. So if you throw in a bank holiday or throw in a weekend, you may not get your money for 4 or 5 actual days. But if it was digital, you could do, they call it atomic swap. You immediately, bang, the money is delivered, the securities are being delivered. So that's what I mean by digital money as opposed to electronic money. But there's 3 types of digital money. There's central bank digital currencies, tokenized deposits, and there's stable coins. And that's what we have. But currently in the UK, the legislation is not there in the guidance. We don't have a central bank digital currency, and we don't have stablecoin regulation. But you're seeing stablecoins, people like Tether and Circle are obviously the 2 biggest, growing very, very quickly as people realize that it's faster, cheaper, and greater transparency to use D-money, digital money, as opposed to e-money.
Yeah, that's true. And once again, a little bit boring with the financial terms. Another level that we might think of is that actually the monetary base is some kind of reflection of the work produced of the specific country in a year. Because in this case, the value itself is amount of the labor and production that happened in this specific period. And how it's covered from the D-money, because in this case, someone needs to issue, and there is a question with inflation and the value. So how do you think this side is covered?
Well, see, this is one of the challenges. If you go back in time, inflation really wasn't a big problem. We had bouts of inflation where inflation, had become very, very problematic. Good examples of that when you saw the tulip mania in Holland. Arguably inflation didn't really take off until the Spanish bought back galleons, huge ships full of gold. And they had so much money, they didn't know what to do. And they bid up and they went and bought real estate and paintings and all sorts of other bits and pieces. But if you go back long term, certainly in the UK economy, where we have some reasonably good records, inflation hasn't been a problem. When we actually came off the gold standard and central banks could just print money, then the definition by many economists, too much money chasing too fewer goods equals inflation. And what's happened is central banks have been allowed to create money, and that has resulted in a lot of price pressures, and inflation takes off. But if you can't create money because it has to be backed by real estate, a commodity, then actually that should be more deflationary. So therefore, digital money ought to. Now, I must stress, when I'm talking about digital money, I am not talking about cryptocurrencies. I'm not talking about Bitcoin or Ethereum or Solana or Avalon. I'm not talking about that at all. But I'm using the technology of cryptographic technology that will actually store the representation, the tokenization of that unit of account.
Okay, that's really good to highlight, because I'm also the big fan to deliberately split the technology as blockchain from the crypto, because there is a math, there is a crypto technology which is encrypting and making it hard to change something in blockchain, which is completely different from the crypto. Crypto is just way of using blockchain. And quite interesting then to jump into how do you see the proper process of issuing those digital currency? Because that's an important door which it should start with. And how do you see this process? Because as we talked, there is a labor. And if we take a look, I don't know, 300 years ago, inflation wasn't an issue because there is a labor, there is something that money represents as, I don't know, precious materials. And then we have this value. So how do you think in this process, the digital money, real digital money should be issued and controlled? Is it centralized? Is it issued by central bank? Is it another way?
Okay, so look, you've got me on a history tour now, so I'm going to take you back even further, and I'm going to take you.
That's cool.
I'm going to take you to the Pacific Islands. Okay, and believe it or not, they used to mine, physically cut out big stones of rune stones, and some of the biggest ones are actually held at the Royal Bank of Canada in the head office, massive one in their reception, and then they would sail these stones from one island hundreds of kilometers to another island, and when they got them there, they would then do a measurement between their finger and their thumb, and that represented, I think it was a large hog and a canoe from memory. And they didn't need to move the stone. So the stone sat outside. You'd gone and mined it, a bit like Bitcoin mining. You'd actually chiseled it out. You no longer owned all of that stone because it was then carved up and it was all around the stone. And so they'd done fractional ownership of a big stone. Now, some stones were really, really small and they could just give you. So in the same way, digital money is giving you a fractional ownership of something tangible. Now, that tangibility could be gold. It could be real estate, or as I say, it could actually be physically cash that's held at a central bank or indeed in a money market fund. But I think what we need to be careful of, and again, sorry to go back and use the history analogy, but in 1863, there were between 8 and 10,000 issuers of US dollars.
Yeah,
you had stagecoach companies, you have shops, you had states, you had all sorts. Now, most of them were not great. And then centrally came and said, well, look, you know, the Mexicans, they've got this funny sort of sign. It's an S with 2 lines in it. That's now going to be the sign for the US dollar. Everything else gets banned. So back in the day, Wells Fargo used to issue their own currency. And they said, no, you're not doing that anymore. And then what they tried an experiment to say everything's going to be backed by gold. So it's interesting because actually the US then actually misappropriated. They actually took all your gold. You couldn't have gold. And they stuck it all in Fort Knox. And now they're talking at the moment about tokenizing Fort Knox's gold and selling it off. And that would actually help to actually repay a massive chunk of the current US deficit. Now, unfortunately, the UK, Gordon Brown, sold all our gold. So we only have 2 bars of gold. One is in the museum, and you can put your hand through a container and you can sort of try and lift it up. And the other one is to say, this is what a bar of gold is. So if you come in and you want the Bank of England to look after your gold, we will compare your gold to this gold to make sure that we have the same sort of thing. I'm going off track here a little bit, but my point is that nothing's really new. We had great big lumps of stone and people then carved it up and gave fractional ownership. And we're going back to a similar sort of thing. And this idea of being able to barter, and someone like MasterCard is a really good example of their multi-token network, where they're saying that we believe people will want to swap their fractional ownership of a house for a fractional ownership of some gold or fractional ownership of some shares. And we're beginning to see this fractional ownership coming through more and more. But the other thing, just be careful because words can be misinterpreted. And the biggest issuer of tokens in the world is Visa. If you go on to WorldPay, go onto their site, an 18 billion US company, they have a subsidiary called PayRisk, and they talk about tokenization, and they're talking about how they use tokenization to capture data and tokenize it and that helps them to prevent fraud. Nothing to do with blockchain, but they're basically capturing and tokenizing information into packets, which the packets in themselves are meaningless if it gets hacked into. So the idea of tokenization always is something to do with a DLT or a blockchain is clearly not correct. And the Chinese have confirmed that by they have a central bank digital currency, doesn't use DLTs or blockchain. Effectively, it's issued by one entity, but it has a lot of the properties that we think of when we talk about a central bank digital currency.
And here I would add, actually minting tokens is not really a new idea, because a lot of companies in the United States, like back then, where it was possible, they even were minting own tokens for providing the food to employees, and then they can change for real money in the end of the month for like getting their salaries. So that's kind of that we can learn from the history. But coming back for the technology, like, it's quite clear. If it's centralized, then we don't need to rely on the technology to prove that something happened on the network. So blockchain, maybe to highlight to our listeners, that's maybe the part when you want to have it decentralized and you have a lot of actors in the system and you need somehow to prove that something was happening. And even with this case, like we've seen a lot of things with the blockchain recently happening, like the latest hack for $1.4 billion that recently happened, but whatever. So in this case, to maybe sum up a little bit the discussion that we have so far. So we're talking about the technology which is allowing us to tokenize something. It's not the question that we would like to go the same way as a crypto. We would like to put the proper distinguish between the electronic money, which is computer records, into the tokenized entities, which can be exchanged and which is more importantly, almost immediately between parties without relying on the banking infrastructure and payment infrastructure that we have right now. Another question, and we will jump into the payment process because it's really important. The last question maybe then I have with the tokenized issues or items, you have an ability to trace, because then it's not like computer numbers. Today you had Igor and tomorrow Jonny. Then you can trace kind of the flow of those money. Is it going to be an issue? Because some might not like that. They know that the money came from you to another person, then you can be traced back for, I don't know, even from 10 years from now, where you got those money and where you spent them.
So, well, first of all, in the crypto world, you have things called privacy coins, okay, whereby the idea is it's very difficult for you to know where that money's come from, who owns that money, and it's very difficult to trace that. Now, interestingly, we've written about this week in Digital Bytes, and you would say on the face of it, well, no one should be allowed to have privacy coins, and you shouldn't be able to hide your money. Well, what happens if you are in a country that's being oppressed and you're a journalist and you need to be paid for your opinions and your insight and your views? Well, if they can track and trace you, then you'd be very foolish to take something that can track and trace you. Now, in most jurisdictions, privacy coins are banned. They're illegal, but not in America, which is quite interesting, I thought. But your point is also very relevant, because with the digital money, it leaves a digital fingerprint. So yes, some of the money does get hacked. Nowhere near the amount of money that gets stolen and the fines that done with the banks, with the KYC and AML. But if you've got a digital fingerprint, it's easier to track and trace where that money has come and gone from. And people say, yes, but I don't want a central bank digital currency, because why should the government know what I'm spending and why should they have control? Well, I'd like to remind our listeners of what happened in Canada when the Canadian truckers blocked the border into America, and they looked at the number plates on the lorries. And they said, oh, John is he's a big in the Big Bear refrigerated trucker, and his registration's linked to his bank account. Guess what? I went in to go and buy a Starbucks. Couldn't do it. They froze my bank account. So governments already have a lot of control that we don't like to admit to in the current situation. And now we have the situation in Europe whereby it's illegal to spend more than €1,000 in France or Spain. It's illegal to spend more than €500 in cash in Greece. And the Europeans are very, very keen to introduce a central bank digital euro, because the digital fingerprint, they can track and trace illicit gains, because the shadow economy in Europe is somewhere between 11 and up to as much as 35%. And I would imagine every single one of you listening to me now are part of the shadow economy. Every single one of you has actually paid a builder to fix your leaky tap, or you've gone into a restaurant and said, who gets the tip? Does the restaurant get a tip, or you've been a great service, madam, or great service, sir? I'd like to give you 10, 20, 50 pounds, whatever the tip is. And I want to give you something. Well, how much of that money gets declared? I would suggest not all of it. So without realizing it, we're part of that shadow economy. And if you're going around with cash, it's very easy to get around that. But if you're paying digitally, yes, it does leave a trace. So when these hacks happen, then you can track and trace them. And using things called bubble maps, you can actually see where some of this money is being held. And that's why a lot of the central banks are looking at this saying, are central bank digital currencies, are they a useful tool in order for us to be able to have the ability to reduce the shadow economy? Are they a really good tool to say, we would like to give you money in the event of an endemic again, like COVID? We don't want you to spend it on alcohol and cigarettes and things like that. We want you to spend it on, if you like, nutritious food or medication. So we're going to limit, go back to what you said earlier about tokenization. We're going to give you a token, but you can only spend it in certain places. And that's what the Chinese did when they were actually launching their digital currency. Said I think it was 3 different places you could spend it, and you had 10 days to spend it. And, but in other democracies, they say, well, I don't like that idea. I don't want to be dictated to and control when and who and how. So there's a balance, and there's no right or wrong in this. But if you're a big institution and you want to be able to move money like that, as opposed to wait 2 or 3 days and worry about the counterparty risks, then you can see why some people. So I don't think it'll all go digital, but I wouldn't be surprised if we saw, 20, 30%, because the stock markets are something like 65 to 75% driven by algorithms and bots in your pension fund, in your savings. So I should imagine what's going to, as AI comes into payments more and more, then we're going to see probably, I would suggest 20, 30% in the next 5 years will be driven by AI and programmable. Well, you can't have programmable payments by writing checks or sending money in the post. It's going to have to go digital.
Smart contracts, basically. So some kind of logic, which is triggered by some kind of events. So
smart money. So when this happens, when the ship arrives at the port, can you pay the duty? Can you pay the shipper? Can you pay, I don't know, the import duty, et cetera, et cetera? All that gets paid, and it's triggered not by someone saying it's happened. It's triggered by an Internet of Thing device, an IoT device that geolocates the ship. It's now arrived at Southampton. Make those payments. Or you want to buy a house. Why give your money to a lawyer? Because lawyers have huge professional indemnity insurance, because unfortunately the legal industry have had challenges around that. You keep your money earning interest until you actually you've been told that you've got the deed to the house, and it happens like that. So it goes straight through. It doesn't need to go through all these other convoluted escrow accounts, third parties and people like that, where they're using your interest while you're doing it. So again, for individuals, I don't really see the big advantage of central bank digital currencies in many of the G7 economies. But I do see at a wholesale level some huge advantages and for businesses to get money moving faster in the economy.
That's definitely true, because the tempo of moving money is kind of the blood of the economy. Like, the better system is structured, the better health of the economy. So we're naturally jumping into the payment chapter, I would say. So, and in this case, like, I see that nowadays we fairly have only 2 value threats with the money movements: banks and card networks. And how do you think the digital currency will affect those? Because are they going to take the leadership in those processes? Are they against? So how do you think it will change the landscape for the banks and networks?
Okay, so let's look at the card companies. Let's look at the profitability of the average S&P 500 company. So the 500 biggest companies in America that are quoted, their average profitability is around about 11%. The profitability for MasterCard, from memory, is about 54%. For Visa, it's 63%. So in particular in Europe, they have done a lot to reduce the interchange fees, the amount of money the credit cards can charge you, and have been very successful. If you go to America, you'll see two prices: cash, debit card. If you go to Australia, the difference between paying cash and paying for a meal with a debit card is 3, 4, 5%. So we don't want to walk around with big bundles of cash, but if you can walk around on your phone and you can pay using digital money, then I think you're going to see much greater adoption. So I think it's going to be a challenge to the credit card companies. And that's why you've got the Visa asset platform. That's why you got the MasterCard multi-token network, because they recognize that, and they need to have a complementary product and service for people who want to make payments like that. As for banks, I wonder whether banks will be increasingly challenged by this whole digital money and the whole DeFi sector, because more and more banks are not lending money.
Yeah, that's true.
And if you can actually, the logic of giving your money to a bank, and the bank doesn't pay any money on your interest in your current account, yet for some reason in a different numbered account it pays you 3 or 4%. Why? And this is why we've seen the challenger banks be so successful. Starling, Revolut, Tide, but look at Nubank in Brazil.
Yeah,
110 million customers in 8 years, because they're giving you the experience of a banking of financial services in a much more user-friendly format. And the other banks, the old banks, are struggling in their siloed mentality because they've been going for hundreds of years, and it's very difficult. So most banks in the UK do not comply with ISO 2022, which is they're meant to, which is a much bigger messaging service. We still have predominantly using Swift. Swift is a very expensive email, $25 to send a message. And so we're seeing more competition, and this is why we're seeing the fintech sector being so strong. In the UK, we have about 1,600 fintech companies expected to double in the next 4 or 5 years. In Holland, 850 fintech companies. That's meant to double in the next 5 years. So what we're seeing a lot of innovation and becoming much more user friendly. And let's not forget, there's 1.4 billion people in the world that don't have a bank account, but 2/3 of them have got one of those.
That's a typical case for Africa, because everyone is using mobile phones and top-ups and redeems as a banking accounts. And sorry for interrupting, but I have a question, because, okay, now we have a system where we have the digital currency, we have networks and banks. And usually banks are regulated, and the card networks, they're still certifying you for using the payments, et cetera, And how do you see this proper as a setup for digital currency? Because if I can give it to another person, not the way that I use the bank and the network, then it's potentially the question that someone could take the digital currency from another country, which kind of removes the limitations of the one country, and then it's kind of mixing up, because from, I don't know, being from United States, I can come to United Kingdom and then pick up the digital currency from United Kingdom, go back to United States. So it's kind of moving across the world. And how to see this part will play?
My daughter lives in Sydney. When I go and see her, and I have my phone on me, do I tick the box, I have more than $10,000 on me?
That's a ridiculous moment every time when someone, but once again, the difference is...
But Igor, is it on me, or is it in this thing called the cloud? Where is it? It's not in my pocket, but the phone's there, and I've got the ability to spend 10,000 if I've got 10,000. So what we're seeing is that the old system of a centralized command and control in different jurisdictions is maybe not what we really need and what we really want. And I say that because look what's happened recently with Russia being excluded from SWIFT. Now, what happens if the UK fell out with the Americans? What happens if the Americans said, we're going to turn SWIFT off to the French, the Germans, the Spanish? It would cause all sorts of problems. What happens if DTC, the stock exchange clearing, holds all the equities, or Euroclear? What happens if they fall over? We've got these very centralized command and control structures, but that makes it very vulnerable So the regulator's job is to ensure confidence in the financial markets, but they're very reliant on 2 or 3 different entities. So therefore, having a more decentralized system would make a more robust system. And we all know you can go on and do a virtual private network, and you can download. I don't know. I don't know how to do it, but I know the kids do it now. They can download movies and music, and because we can say, oh, well, today I'm in Poland, and tomorrow I'm in Texas, and next time I'm in London, and they haven't moved just anywhere from their front room. So I think regulators, unfortunately, it's a real conundrum. They can't necessarily control everything. And if you try and control it too much, you're going to stifle innovation. And it was interesting, Andrew Bailey is saying, look, it's not our job to innovate as the governor of the Bank of England. It's industry's job. But the trouble is that, you're asking the industry to go and dig for gold with a toothpick. We need a JCB. We need to be able to do that and get to the gold. But we can't do that because they won't give us the keys to digital money at the moment.
And the left hand behind the back, because then you can do it with the one hand and toothpick. But the question is, just to put maybe into the perspective for the listeners, when you're crossing the border, you have a cash. It's something that can be checked with you. Okay, that's a question how, but still, it's physically with you. With the digital, or not a digital, electronic money, you have something in account, actually travels with you. Like Apple Pay, you have tokenized card, the card is traveling with you. But the money potentially sit in the region where the bank is licensed, where the balance is kind of aggregated as a safeguard account, etc., etc. And when you're paying, it's kind of moving through the network to the local restaurant in Sydney, and the original account balance was in London, in UK. But with the digital currency, you can, I don't know, put into the...
It's everywhere.
It's not really everywhere. It's some kind of tokens, which potentially some network, but as a wallets, let's take a look on the example with the crypto. You have wallets. There is an ability to encrypt, decrypt, and have an ability to control and move the items with the wallet. So it's not like you're moving the tokens, it's you're moving the instrument that is allowing to move those tokens.
So that's what I think what's going to happen is that probably the wallets will replace the banks. So you'll be doing KYC and AML on wallets, not necessarily the owners of the wallets, and not the banks. So actually, because the wallet itself, if that's where it's being stored, and that's going to become increasing. In the same way, if I went back 30 years ago and said, look, I want a phone that actually has a torch on it. I want a phone that takes a picture. Why you want a phone, Johnny? Why do you want these other things? And I think that as we start to see digital money coming through and programmable payments, it'll make people's life more efficient. It'll save money, and it'll actually make the economy run faster. But it's just too big a leap to go straight into that. We need a series of sort of baby steps, which is why we've been working on this idea of a programmable bank account, whereby you have a normal bank account and then it accepts instructions to come into your bank account and say, okay, if the ship docks, then pay this. If you buy a house, pay your stamp duty, pay the lawyer's fees, pay the money to buy the house. If I buy a share, then pay the stamp duty, pay for the shares. So I think as we start to see more of this intelligent, programmable, smart money, however you want to call it, and all that can be done at a banking level. This has nothing to do with digital money now. I'm talking about a standard bank account that accepts APIs instructions into it based on a third party. So if you and I agree to do a transaction, and I'm in Germany, and you say, well, Johnny, I don't know who the heck you are. I tell you what, though, I'll pay you 20% when it's picked up by DHL or UPS or whoever. I'll pay another 20% when I know it's on the airplane, and then I'll pay 60% when DHL deliver it to my factory. And it's not I will pay. We've set it up automatically. So as those, if you like, pre-agreed markers happen, then the payments go across.
Yeah, and it feels a little bit, since we having a lot of historical reference, it actually feels as a development of internet itself, because from almost day one, we have mailing service. Like basically we have POP3, you can exchange emails. And actually this story with the World Wide Web is kind of similar, because we had the hyperlinks as Gopher, and no one remembers Gopher because it's actually is dead, and the technology which replaced is World Wide Web. And I think something similar we are facing here. So we understand that we need better money, better movement process, and the technology is kind of gopher. Like, we can do the things, but it's kind of limited. And maybe it's going to be some time when we will switch to another abstraction, which is fully closing the life cycle. Like, we can own the money. And going back with the example with the moving through the border, actually you have a token where you have the wallet, which is holding a specific tokens, which is kind of as a cash, but in the digital form. That's why it's digital. And that's kind of this example with the gopher. So you might have emails, which as a cash and coins, then you have electronic money, which is gopher, but maybe we will go into the level for a World Wide Web with the real digital money. So it's really interesting and fascinating to think about that. How do you think the payment landscape will change? Because if we're not limited anymore with the networks and like it's going to be fast, is it going to affect the economy? Because right now it's once again the blood. Like, what do you think, and what is your prediction? What will be possible, or what will be enabled by this digital currency approach compared to the current state?
Well, it's going to be much more efficient. It's going to be cheaper. And I think that it'll enable real-time settlement, and it'll enable the proper use of technology. So I think that, take auditing, for example. You know, when you carry out an audit and you're looking back over your shoulder, what happened 3-6 months ago? You want to know, has something happened this afternoon that as a shareholder I'm worried about, that I need to be accountable? There's no point what happened months ago. And as we get information in a digital format, you'll be able to have reporting on a what if basis, and you'll be able to have reporting on a risk basis, not someone's interpretation of it, but some parameters put around that. So, you know, the cost of KYC and AML is, I believe, I'm going to get this number wrong, but I think it's something like 20 odd billion a year. That's what it costs just in the UK.
That's
Now,
a huge number.
99% of us are not criminals. Yet we all have to go through that same loop. And if you don't believe me, go down to your bank tomorrow. And if you've got more than £2,000, say, can I have £2,000 in cash? What do you want it for? Why do you want it?
Yeah.
Yeah. Well, hang on, it's my money. Oh, sorry, we haven't got it. Can you come back in a couple of days? Or if you're going to put £2,000 in, where'd you get it from? What's happening? What's going on? Now, it's because they're worried that you're doing some sort of nefarious activity. But so they're painting everyone's painted with the same tar brush. Or if you go to America and you have cash in your hand, well, that doesn't make you some sort of drug dealer. But 98% of US T-bills have traces of drugs on them. So we're using outdated technology and ideas in a digital environment. And that, so therefore the impact, I think, will be, we'll have much more efficiency, much more transparency. And I think that's got to be, but you'll also have an alternative. People still walk around with cash. The government in particular in the UK writes millions of checks.
That's another fascinating piece of the technology in 2025.
But America, there's a very big search engine company that I was talking to 18 months ago. They reckon 30% of their income comes from check writing. Most Americans write checks to pay for their utilities every month. The biggest, most successful economy in the world, yet their payments and the banking system is perhaps not as smart as it could be.
That's definitely space.
But it's the unintended consequence I think we need to be mindful of. And stablecoins are a good example of that. We're effectively seeing the dollarization of many other developing countries, particularly where they're inflation prone, because people would rather hold a US dollar proxy, a stable coin, because it's cheap, it's fast, it's safe. You're not walking on big bunches of cash. It's an inflation hedge. And so what's happening is that America is influenced because people are using dollars more and more and more. And it's very much supporting an ailing currency. Because if you look at the world reserve currency, typically they only last for about 94 years. The US dollar has been well over 100 years. Because before the US dollar, what was the world reserve currency? Come on, Igor, you're good on history, I've decided.
Actually, I cannot pick up from mine. Sorry, that's a question that I cannot answer.
It was pound sterling, and before pound sterling, French franc.
Oh, French franc. Okay.
Before the French franc, Dutch guilder, and before the Dutch guilder, it was the Spanish peseta, and before the Spanish peseta, it was the Portuguese real. So I've now taken you back to 1484. So these things are all cyclical, and the US dollar at some stage will no longer be the world reserve currency, but perversely, stablecoins are helping to keep the US dollar as a very dominant currency. But if people no longer trusted the dollar in the same way they gave up trust in the pound, then, you know, given the huge deficits that are in America, that creates a lot of questions. So the question is, what will be the next world reserve currency?
That's a really hot topic nowadays, I would say, especially with all events happening for last week.
Yeah, but I know what it won't be. It won't be bits of paper.
Yeah.
It won't be bits of paper. It will be digital in nature.
Because we're living right now in the digital world. And I think another important thing that you mentioned is trust. Because I think the trust is shifting with the generations. We have kids who are barely talking, but they good with the technology, touch screens, and they can understand the technology before even learning how to talk or even write. So that's definitely a big shift into the adaptation and the perception of the technology. So it's quite a fascinating moment to live and see how it will evolve and will affect the payment industry. So I think we're kind of coming into the end. We discussed for quite a while, and thank you. It's really insightful conversation. And as usually in the end of maybe you want to add something, like the closing moment.
That's well. I suppose the only thing I would like to add is that, look, blockchain is no more than an Excel spreadsheet on steroids. It's not a, you know, don't get too carried away with it. But what blockchain does give you, it does give you more transparency. If you have more transparency, then to go to your last point there, it should give you more trust. If you have greater clarity, then you should trust the system a little bit better. If you can see where your money is, where your assets are. And I think to your point is very, very correct there, that it is about trust. And I think that's one thing that blockchain can give you. But tell me about your book. I'm interested in this, Igor.
Okay. So today, since we went into the history, my pickup for the today's book is Tower of Babylon by Ted Chiang. It's a sci-fi, and it's pretty insightful because actually that's maybe even overlap with the topic. The whole story of Babylon Tower is well known. It's like biblical, but Ted Chiang did amazing work putting into the sci-fi approach into this, and it's quite short one. It's novelette, but really, really recommend to read it. It gives a lot of insights and maybe self-reflection moments to understand how the usual things that we perceive might be the different thing. So that's might be the topic of today's podcast.
Okay, have to look out for that one.
And what is your book?
My book is Breathe.
Okay.
By James Nestor. And in the same way, payments are at the heart of every business. If you don't breathe, you don't survive.
That's true.
And if you actually learn how to breathe properly, most of us don't breathe through our nose. So if you actually learn how to properly breathe, actually the carbon dioxide is almost as important as the oxygen in your body. We need both. So if you exhale quickly, you're getting rid of what your body needs. If you don't breathe in properly and actually hold your breath, you're only half filling your lung. So actually, there have been some really interesting studies which the book goes into, where some of the very ancient sort of people over the hundreds, thousands of years have actually taught their children how to properly breathe. And I think that in this day and age, we've lost a lot of that art of how to breathe. I know that might sound silly,
No.
But actually learning how to breathe again, I think you might find it quite insightful, and it helps with sort of, with calming your nerves, helping you sleep, and actually helping your general health. So some really great examples of Olympic athletes that have been trained how to properly breathe, and it improves their performance.
And actually, I think it's affect the brain activities, because it's for us as a human and complex structure is important to have a fuel or as a payments in industry in proper way with the proper timing. So it's pretty fascinating choice. Thank you for sharing this book. I definitely will look up and will try to find the time to read it. Thank you for the recommendation. Really appreciate it. So thank you for joining for today's podcast. It was really insightful conversation. And for me, it's a great pleasure to discuss this topic with a lot of reference into the history and insights. It's really good one. Thank you for your time and appreciate everyone listening to us today.
Thank you.
Thank you.